AMD. So AMD, some severe changes going on with AMD. I want to explain what's going on here, why the stock's seeing so much momentum, people taking profits too early, those sorts of things, right? The way I'll put it to you like this, okay? We don't know what's behind the curtain right now. We know, like, Lisa Sue's back here, right? The financial statements are back here, and we know it's going to be great. We know the next several years are going to be great in terms of AMD numbers. There's no debating that anymore at this point in time. That might have been a debate some people were engaging in 6 months ago, 12 months ago, 18 months ago. But that's no longer, like, now we're seeing the deals with OpenAI, with Oracle, all these others, right? Meta relationship, Tesla relationship, all these companies. We now know AMD's numbers are going to be a banger for the next several years. We just don't know how great, right? That's the thing. We know it's going to be great. When those curtains open, it's going to be great. We just don't know how great. And it's one of the most exciting times to be investing in a stock when they're about to open the curtains and you know it's going to be great. You just don't know how great it's going to be, right? Let me show you my AMD projections here, okay? This is my bull case I have for AMD. This is if things go better than I expect. I've been doing 40% revenue growth per year for the next 4 years, 2026 to 2029, right? And 50% net income growth, that puts them at net income margins of 22%, which is less than half of NVIDIA's. The stock goes to $1,000 by 2029. $1,000. What if hypothetically those numbers are too conservative? It's something you have to consider. These growth rates wouldn't even be remotely close to the growth rates NVIDIA started to report. NVIDIA started to report 100 and 200% type revenue growth rates. This isn't even in the same ballpark. NVIDIA can post like 40, 50% net income margins, right? I have their best case scenario that net income margins only get into 22%. 22%, and the stock goes to $1,000. What if that case is low? It's something you've got to consider. This is what I actually expect AMD to do, right? This is my base case for the company. 35% revenue growth per year, 2026 to 2029. 45% net income growth per year on average, 2026 to 2029. Net income margins, once again, 22%. If you're growing at those sorts of growth rates, 50 to 60p is very fair. That puts the stock somewhere between, we can call it about $750 in low 900s come 2029, which gives me a CAGR of, we can call it 30s to 40%. Woo! What if that's low? It's possible. It's very possible that those numbers end up being low. And the net income margins I have here at 22% come 2029 are laughable. And the revenue growth of 35% on average is laughable. That's very possible, right? And so you got to understand, you do not want to sell a stock. Like, why am I couldn't even consider selling one share in the public count of AMD right now. I got, 2,555 shares or something in there. I couldn't even consider selling one share right now because I don't know what's back there. I just know it's great. I just don't know if this revenue growth is going to be 30% a year for the next several years, 40%, 50%, 60%. But if it's 40% plus on average, this stock could run to 1,000. And I'm not going to look to get out of a stock at 200 or something when it might be on a run to 1,000 over the next 3 or 4 years, right? So this is not a moment you want to cash a stock like AMD. This is a moment you want to hold every share as tight as you possibly can. And there's a reason people keep buying in the stock in a relentless manner day after day. Remember, we haven't even started seeing numbers yet. We're just going to start getting a glimpse of behind the curtain when they report their numbers, in about a week from now, right? They'll give us a first glimpse of like what is actually going on with AMD, right? And we'll get to see the numbers, the guidance. That's just a glimpse. And that's going to give you some intel on like, oh shoot, things might actually be better than we anticipate. And remember, the 400 series, that's next year's story. So the numbers, whatever you're seeing this year is going to be kind of a joke compared to what you're going to see next year and in 2027. So keep that in mind, folks. Like we got a long game to play out here in regards to AMD, right? Now you might ask yourself, well, what if the market corrects Q4, Q1, which is fair. Like that might happen, right? You might get a correction this quarter or next quarter, right? Like that's going to pull down all stocks. If that happens, that's no guarantee, but if that happens, it's a realistic possibility. Who cares? Who cares? Like, okay, let's say AMD goes to 275, then we get a correction in the market and it falls to 225. Oh, wow. I'm not going to try to create a taxable event and try to worry about getting back in at the right time for a stock that's probably on the runway to $500 to $1,000 a share. No. I'm not going to say, okay, stock goes 275, I'm going to cash, Then hopefully the market goes down, brings AMD down to 225. I'm going to get back in AMD, get $50 of arbitrage per share, then ride it up to 500 to 1,000. No. Because I don't know. Like, what if we don't get a correction in this quarter or next quarter? And AMD just keeps running. And next thing you know, that stock's 300, 400. Then next year it hits 500, right? And then over the next few years, it ends up eventually reaching 1,000. I'm not going to play that whole game of, with long-term investments, you just let it play out, okay? And then once again, at some point in time, AMD will get to a price where it will make sense for me to start taking profits. But it's not even close to being there. It's not even close to being there yet. I mean, when I run my base case and I'm still at 30 and 40% CAGRs, it's not close. We're not even close to the stage where I start to take profits. This stock runs to 500, then I can start a 400 to 500 range. Then I can start making a case of maybe it makes sense to maybe take some profits here and there. But that will depend upon growth rates. What if by that time AMD is starting to report 50, 60, 70% revenue growth? Well, shoot. Then it won't make any sense because then AMD is probably going 1,000 plus. That's, you got to run the math. When you run the math, then you can start to figure out, okay, it makes sense to take profits or not, right? And AMD's at a big inflection point in their business for the next several years. So we don't even know exactly what the math is going to be, but we just know it's going to be dramatically higher than where we're at right now, right?
Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com.
Next up here, Sofi over Hood. So Sofi, let's talk about this for a moment. I think it's an important subject in regards to my take on this, right? So I like Sofi a lot. The thing that's really fun with Sofi is their growth rates just accelerate in a very meaningful way. Additionally, the thing that's cool about Sofi, in my opinion, is they're not reliant on the stock market going beast mode like Robinhood is. Robinhood is extremely reliant when you look at where their money comes from. Robinhood's extremely reliant on a lot of activity in the stock market and a lot of activity in crypto. It's just the facts, right? And so if there's a big slowdown in the stock market in 26 or 27, right? And a big slowdown in Bitcoin's appreciation, those sorts of things, and Ethereum, if there is a big slowdown, Robinhood numbers will be negatively affected by that. There's no debate, right? Now you look at Sofi. Sofi, that's not really important to them. Sofi is more of a traditional bank, but more fintechy, right? Digital first. But they're relying much more on banking related stuff, right? Somebody says, oh, I got this credit card loan that I have to pay a 25% interest rate on. Why don't I just take out a personal loan through Sofi that I have to pay 8.5% on, right? That's the beauty with Sofi. So they're doing more traditional banking related things like that, right? Then that person takes that personal loan that they got at Sofi that maybe they're paying 8.5% on, right? They go pay off their credit card loan that they have 25% interest rate on, and now they're paying interest to Sofi, right? And Sofi likes to remain pretty asset light. So many times what they'll do is they'll go ahead and sell off loan volume over to somebody else, right? So they don't have to actually take the risk on their books, and they might just like to be a little bit more of a fee platform, which keeps you asset light, margins higher, right? It doesn't give you as much upside potential in terms of making money as if you just kept all those loans on your book, but at the end of the day, there's risk that comes with that as well. Like, okay, somebody had $10,000 in credit card debt. They go ahead and take out a personal loan through Sofi, right? $10,000. So they pay off that credit card debt. What if that person doesn't pay back that $10,000? Like, that's always a risk, right? And so that's where you, as somebody that's in that banking system, somebody like an Anthony Noto has to figure out, okay, what do we want to keep on our books versus, get off our books, right? And sell to somebody else and make some money off of that way, right? Now, with Sofi, the thing that I really like about SoFi, if you compare it specifically against Robinhood, is if you look at the 2-year forward P, the 2-year forward P for SoFi starts to look very attractive, significantly under Robinhood. Now, meanwhile, the expected revenue growth is expected to be still extremely strong next year and in future years as well, whereas Robinhood's expected that growth is expected to decelerate quite significantly next year, right? It looks like analysts have next year's revenue growth for Robinhood somewhere around 15%, let's call it, right? Whereas SoFi is like a 25% plus number. And keep in mind, SoFi just started really accelerating growth in a meaningful way, so there's a potential that maybe they do revenue growth of 30% plus next year. Potential. Keyword is potential, right? Now, if I look at something like PayPal, the very attractive thing about PayPal is right here. Look at the trailing 12-month PE, the forward PE, and the 2-year forward PE. We're talking a 15 trailing 12-month PE, well under where the market trades at. Market in general, trailing 12-month PEs are 20 to 28. Look at the forward P here. We're looking at 1000xstocks.com. 13 for PayPal. Market in general is usually 18 to 26. So we're like half, and then 2-year forward P is 11 for PayPal, and the market in general trades in kind of that 16 to 24 range. So roughly half, a little less than, a little more than half of an average stock out there. Meanwhile, the company's growth rates are kind of what you would expect from an average stock out there. If you look at current year expected revenue growth, 5%, next year 6%. Like, yeah, it's not the most exciting thing, right? And if you compare it versus a Robinhood or SoFi, it looks boring. But that valuation is not boring, right? Hood and SoFi both come with a lot more risk than PayPal, because if those ones' growth rates were to go down considerably over the next year or two, the valuations have to come down considerably on those stocks. PayPal's P ratios are already so low that even if the growth was to go down a few percent, the stock doesn't have much downside. So with PayPal, you don't get very much downside. You really only get that upside potential. With Hood and SoFi, you get some more upside potential than PayPal, but comes with more risk because of PEs. And so that's where you have to play the game as an investor and try to figure out, okay, what's my best option here? So I like a combo of SoFi and PayPal, because PayPal, I'm getting that, much lower growth, but guess what? Very attractive valuation. SoFi, I get the super high growth, the beast growth, but a higher valuation. So I like kind of playing both of those as kind of my fintech plays, and that's why I'm invested in both those companies. You can see them both in the public account. Next one up here, Morgan Stanley's Mike Wilson.
But you've been of this long-term view that we're in pretty good times for quite a while to come. You're still feeling that?
Yeah, I think our differentiated view is what we talked about, I think the last time I was on the show, is that we believe that we are in a rolling recession for the last 2 or 3 years. The private economy has been quite weak. Yeah. I think the Treasury Secretary sort of said the same thing. And now we're in a rolling recovery. The recession itself ended with the Doge layoffs. And if we look at the data closely, and we've documented this, it shows very clearly that there was a spike in layoffs, and there was a low in all the jobs creation, which the revisions now are proving. And the stock market figured this out. The stock market is smarter than all of us. And the confirmation for us is that the earnings revisions now have really exploded higher in a way
I got my new lifetime membership card for the private stock group here. Ooh, look at this baby. Oh, it's gorgeous. I got to keep it in the plastic wrap. It's too nice. And that's in addition to, when you join us in there, you get your 1000X Steel membership card. And then you also get your private stock group Steel membership card as well. Absolute beauties. That is pinned comment down there.
Only do in a new economic cycle.
That's what I think is so interesting. David Solomon was here just a little bit ago, and he called this late cycle. You think we're still early cycle?
Well, I think we just transitioned. Yeah. Now, where I think I also have been differing, is that the cycles aren't going to last that long. Right, we're now in an inflationary regime. It's very different than all of our careers where inflation was coming down. And what that means is that these cycles can't be elongated the way that they were, because the Fed has to respond ultimately to higher inflation. Think about the last 5 years. 2 years on, 2020, 2021, 1 year off, and a nice recovery in 23, 24. Then we had another kind of capitulation recession in this year. And now we're into a new 2-year cycle. So you just got to keep that in the back of your mind.
That's not that different than what he was saying then. David Solomon was saying, we're late cycle, this could have another year or two to run.
That's right. But I think that context is important to distinguish, because if it's late cycle, then you only want to own sort of defensive, high-quality names. In an early cycle, new recovery, the market will expand. It will broaden out. And that's kind of what's starting to happen now. We think that's the story for 26. It looks a lot like 21 in that regard.
What do you like?
Well, we like a barbell at the moment because we still think the Fed needs to cut rates. So we've been on the cyclical side. We have liked a lot of the tech sector. We have like financials. We have like industrials. That's the pro side on the cyclical side. And then the defensive high quality side, it's basically healthcare right now. We think healthcare looks quite interesting. Now, we do think the Fed will get with the program and they will start cutting rates in a more meaningful way once the labor data confirms what we all know, which is that the labor market's not that good. And when that happens, then we can really transition to the interest rate sensitive parts of the market that have been languishing, things like housing, things like consumer goods, all the durable goods, the areas where there's pent up demand.
How difficult is it to not have government data at this point? Yeah, because you sound so sure in your beliefs on these things.
Well, I think the government data that we're waiting for, everybody's waiting for, is mostly the jobs data, but that's backward looking. I think we've already confirmed that the trough was in April. That doesn't mean, by the way, we're totally out of the woods. But what it means is that I don't think we're going to learn a whole lot from this data that we're not seeing at the moment. I think it gives comfort. I think it will give the Fed the cover to do what I think they need to do, which is cut rates in a more meaningful way. So to me, that's the risk, is that we don't get the data that allows the Fed to cut more meaningfully.
And when you say more meaningfully, you're talking about more than 25 basis points at a clip?
Exactly. Let me just put it in context. So the Fed is behind the curve, in my view, until they get lower than 2-year Treasury yields.
Okay.
Today it's about 75, 85 basis points. So that's just 3 cuts to get to neutral. To get ahead of the curve, they probably got to cut 150 plus. And the only way they're going to do that is if we get weaker labor data, which I think is probably forthcoming, or we get some sort of bond volatility or financial stress, the third mandate, if you will.
All of your thoughts about the market continuing to climb from here, what would happen if we do get some of that bond market turmoil that you're talking about, or tensions continue on this China trade front? Because that's been the macro issue that has made markets wobble recently.
Yeah, so I want to distinguish. Our 12-month view is quite constructive for the reasons I just laid out. But in a short-term basis, this is probably the first time since April that I think we have maybe a tradable correction. And it would be those 3 things you mentioned. First, the China-U.S. trade tensions. We're kind of walking towards this, deadline. The markets may get nervous around that. And by the way, it's a correction. It's not like we're going back to where we were in April, but a 10% correction would feel pretty nasty. The second reason would be we get funding market stress, which, by the way, the Chair Powell talked about last week. That's one of the reasons why we may, end QT a little bit earlier next year, because we're starting to see a little bit of funding stress, which is...
Okay, 10% correction. Listen, he mentions all that feel painful, right? I think it really depends on your time frame and what have you been through, right? So put it like this. If you ever done track workouts before, like an actual like sprinter workout, right? Most pain you'll ever go through in your whole life as far as like physical pain from a workout. It's a whole different level than football, baseball, basketball, soccer. It's almost laughable to other sports, okay? Do a track workout sometime, like an actual sprinter workout. Like run like 8 300s hard. You probably won't make it through it because you'll probably pull all your hamstrings, okay? But try it sometime. Pain. That's the stock market. You've been through pain. You started like I did in the great financial crisis. You went through the 2020 crash. You went through the 2022 crash. You went through this massive amount of corrections we've had over the years and the pullbacks. I didn't even register. Even what happened in April, I didn't even feel it. Like the public account went down to 2.5 mil. Right? It was above 3 mil prior to the fall. Then it goes down to 2.5 mil. Who cares? I didn't even feel it. And that was a pretty actually significant drop for the S&P 500. S&P 500 dropped, a pretty good double-digit percentage. NASDAQ as well. But I was like it didn't even register to me. It was almost irrelevant, that April drop, right? And so, but I can understand if you just got in the market and all of a sudden you go through something like that. That's like, whoa, like, oh my gosh, like going through one of those workouts, like brutal, right? And you're like, oh my God, what's going on here? It's the same thing. So the more experience you get the more crashes you go through, corrections, pullbacks, the more all this stuff is just nothing. Like it would take, for me to really feel it, it has to be a NASDAQ down 30% plus number. If it's not NASDAQ at least down 30 plus percent in less than a year, it can't even register. Like 2022 registered with me. You know why? The NASDAQ went down like 38%, 37 or 38%. It happened quick. It happened in about 11-month time frame. That will register with me. I'll feel that. Whew, well, I feel that. But outside of a 30% plus drop in the NASDAQ, it's all just kid stuff, man. Send the market down 10%, put me to sleep. Like, I'll just gladly take advantage of some good deals in the market. But other than that, that's nothing.
Essentially, the bank reserves are maybe a little bit too low for the liquidity we need, not just for the financial markets, but now for this economy, which I think it could be booming next year. So those are two reasons I think we could see some corrective activity in the near term. I don't think it derails our core view on the rolling recovery.
It's nice you said all of us have spent our entire careers in a low inflation environment. It was nice that you
One exception.
It's nice that you threw me in there. And just to, because it's hard to believe, inflation rate, right when I started in the business, 13.5%. Inflation rate, 13.5%. Unemployment, 9.5%.
That means he was in the 80s.
Wow.
And what was
9.5.
like a 30-year mortgage?
Prime rate went to 21.5%. And the 30-year mortgage was 15 or 16. No one was ever going to buy another home. Mm-hmm. And I was lucky enough, we at Merrill Lynch were lucky enough to design a product where you, instead of getting 13.5 tax-free municipals, we did a floating rate thing.
Oh.
There you go.
Oh.
Instead of locking that in, we put people in, hey, you don't have to worry. It wasn't going up from 13.5. That was the time, but
30-year zero coupons, what you wanted to buy.
Exactly.
That's what my mom was pitching.
Because they're not, you couldn't call them. Because
That's right.
yeah, exactly. They weren't callable. Yeah, but when you think about things being bad, think of 13.
Yeah.
I mean,
I can't.
That's like almost speaking of Argentina, that's like a South American type inflation rate.
But I think it's important to distinguish, like, inflation is not bad for stocks, okay, because it creates earnings growth. It's just different.
Yeah.
And
It's
if you
painful
think,
for everybody living through it, though.
well, it's painful for the consumer,
Yeah.
right? And that's why we have this bifurcated economy. But don't fear inflation next year. In fact, if we don't get inflation next year, I'll probably get more bearish, because that means the earnings story is probably not going to deliver on what people are expecting.
Wow. So that's quite a flip, right? From inflation was bad to now inflation's good and it helps earnings, right? But think about it in this frame of thought, right? Because I do think it's important everybody understands how inflation works with a business, with a company, right? Okay, so let's say hypothetically, let's use Apple as an example, okay? And we're going to use completely unrealistic numbers here just so I can illustrate the point and keep it real simple math, right? That way everybody can understand this point. Let's say inflation's so high, let's say Apple's cost on making an iPhone goes up considerably, right? Let's say the cost of making their highest end iPhone goes from $500 to $1,000, right? Okay. And let's say that phone they usually sell for $1,000. Well, if Apple keeps it at $1,000 and it costs $1,000 to make it, they have 0% margin, right? They have no margin there. They're just doing business for free, I guess. Like, they're not going to actually make any money. So now, before, their profit was $500, right, per iPhone. $500 to make it. They sell it for $1,000. Just using rough numbers here, $500. Now, let's say, okay, the inflation came and hit, so their cost doubled, so they say, okay, we're going to go ahead and double the iPhone price as well, right? Inflation is completely crazy, so we're going to $2,000. So we doubled our cost, right? But we also doubled our price. So now it's $2,000 to buy an iPhone, and it costs $1,000 to make it instead of $1,500 before. Now their margins just actually went up. Now they're making $1,000 of profit per iPhone sold. So as long as you can offset that percent increase, you actually end up making way more money than you previously did. Now, for some businesses, they can offset it. They can go up on the consumer, and it's no problem. Certain businesses can do that. Other businesses can't. And that's where you get into a big winners and losers market. Some companies, if their cost of whatever doing something doubles, they can double that price right back on the consumer. Other ones can't do it. And so some companies really benefit in a massive way, because now they're making way more money than they ever did in this. They're like, dang, that inflation maybe sucked that first year, but after that, it was like the best thing that ever happened to our business, right? Other companies are like, no, inflation just sucks in general, right? It depends. It depends on where you're at. But if you can offset that cost, oh my gosh, it's like the greatest thing to ever happen to you, right?